when super investors start selling their shares, for me at least, it's time to also consider, should I sell my shares as well? And we are going to talk about that today on Investing Mastermind Podcast. My name is Signe
And I'm Michelle Markey.
So usually a part of my what I call exit strategy. So a reason for sell stocks is I want to sell a stock if there's one of the bigger super investors, guru investors, call them whatever you want to, one of the bigger Warren Buffett style investors, if they start selling their stocks, then I also start considering selling my stock. So I do have a checklist, a selling checklist that I will go through, but that is one of the things that will alarm me that, now I need to pay close attention to what is going on. How about you, Michelle? Is that something that you're checking up on, or is that not part of your selling strategy?
Yeah, like for example, when Berkshire Hathaway was selling a lot of their Apple shares, it made me wonder, is Apple overvalued? Why is Warren Buffett selling Apple, which he said was the best company in the world? And he usually never likes to sell companies in his portfolio. So why would he sell what he has called the best one, which they still own it as their number one position, but it's much smaller than it used to be. So yeah, that gave me pause as to whether Apple is still a good investment or not. And yet that's the actions of Warren Buffett are very different from the actions of the CEO of Apple, Tim Cook, who has been buying back shares of Apple. So it makes me wonder who is more right about the valuation of Apple. And of course, these people have different reasons why they want to sell or buy the stock, but it makes you wonder, who do you believe more? Would you follow in Buffett's steps or Tim Cook's steps in whether you should sell or buy the stock? So that's definitely a question investors should ask themselves when they see super investors buying or selling stocks.
That's a really, really good point. What you bring forward there is, what is management doing compared to what are investors actually doing? So that's a really, really interesting, where I probably tend to look more at the gurus and not as much as management. So that's a great point you bring forward. In that case, where Warren Buffett is selling a little bit of Apple, I can share that then I'm also considering, should I reap some reward, harvest some of the fruit as well? So not necessarily sell all of it, but sell some of it. So we can definitely let the gurus guide us in what we should do, but it is so important that we also make our own investment decisions. And one of the reasons why I'm bringing that up is because we have one of the gurus who recently sold 100% of his positions. And I can tell you out there in internet land that the rumors started going, and I'll come back in a second to which investor it was and what happened. But some of the rumors that starts when investors are selling all their stocks is definitely the number one rumor is, should we also sell that business? And that's just where we've talked about which parameters we want to see when we buy a stock or a so-called wonderful business. We can use the same principles in order to make a decision if we want to exit, because if it's still a wonderful business and there's a guru that's potentially selling it, they could be selling it for other reasons. There could be other reasons that we don't know, trimming the portfolio, or maybe wanting to focus on something else or whatever, or changing strategy. That sometimes happens. Even with Warren Buffett investors, we saw Preston Pish from the Investors podcast that changed from Warren Buffett style investing to crypto. There can be different scenarios like that.
And another, say, super investor that makes you wonder what's going on with the stock is, for example, Bill Ackman had bought some Netflix some years ago at, say, something like $430 a share. And then he thought, oh, it's still not generating positive cash flow. So he was a little bit on the fence about it. And then he sold, and then Netflix kept going down. And then it was probably an even better opportunity, perhaps. But then Bill Ackman did not come back into Netflix. So it makes you wonder, was he right to sell it earlier than later? Like maybe it's better that he got out of it. But then did he miss an opportunity to invest in a pretty good company when it was available at an even lower price? So it's interesting when you think investors have done a lot of sound research, but they get spooked or scared at a higher amount and then they sell it. But then it makes you scratch your head. But why didn't you enter it again when it was selling for much lower? So sometimes the super investors make mistakes. They don't always get it right, and nobody has a crystal ball and what's going to happen with any given stock.
Yeah, and that is a great point also because he has principles. He's got his set of principles, his checklist, where it's very, very concrete parameters that he's looking at as well. So even that he would enter Netflix can maybe, out of those parameters, maybe a surprise. That's an interesting move. And we also sometimes with Warren Buffett, what I've seen, I remember one time I had just been reading The Dando Investor by Monish Pabrai. And what Monish Pabrai describes in that book is just copy whatever these successful investors are doing, and you can make a whole lot of money. So I was, quote, lucky that my first investment in where I copied Warren Buffett, I actually got burned really bad on doing that, which means that I've not been following just blindly what super investors are doing since then. So it was an important learning early on when I first implemented Warren Buffett's method of just blindly entering a stock that Berkshire Hathaway bought. And I found out, like, first of all, it wasn't even Warren Buffett. It was probably one of the investment managers. And they quickly exited the same stock. So I do see that from Berkshire Hathaway sometimes, where it's like they come in and they come out, and now I understand more of what it is they're doing. But back then, I just thought, oh, okay, this is probably a pretty good business. I don't understand it at all, and I have no idea really what it's all about, but I'm just going to copy trade because I got so inspired by that. So I also know that Monish learned that since he wrote The Dando Investor. He's not just blindly copying Warren Buffett, but I think he actually started out doing that to a great extent.
I know it can be tempting to just copy investors, and I've done it too. Like, for example, I copied Warren Buffett in buying some Occidental Petroleum just for fun, just to see what it would be like. I don't own that much of it, but it was just an interesting foray into seeing, like, why does Buffett like this stock so much that they bought so much of Oxy? And I was curious. And now that there's some of that Middle East conflict going on, oil is going up. So that company is doing somewhat better in their stock price. So it's not for everyone. And I don't suggest you just blindly copy people like I did blindly, but I feel like it's a low risk investment. Like I said, I don't own that much of it. It was more of a for fun to see what would happen. So sometimes we can have a little for fun portfolio just to try to learn a little bit more about why a super investor is invested in something.
Yeah, definitely. I used to have that as well, like a little bit of fun where I would test things out. So yeah, it's a very good idea to just have a small, maybe 10% of your portfolio or less,
Or
where
yeah,
you
much less.
where you do the risky gambling.
like 0.1%, like something super tiny.
Yeah, exactly. Okay. And I know a lot of people that did the same play with, as they call it, with Oxy, because he's been buying more and more Oxy over the years. That was not the case with the one I jumped into, bought a little bit, sold immediately. So it was like and it was
Yeah.
very difficult to get out of my portfolio.
Mhm.
So let's get back to the investor that's had to actually sell a lot of stocks. And the investor we're talking about is Guy Spier. And if you're following investment land, you probably already heard it. Unfortunately, he's very sick. So what he has decided to do is to close Aquamarine Fund and start a private family office instead. So that news, it's just heartbreaking. We've known for a while, but now the day has come and it's super sad.
Yeah, for sure. I hope that Guy Spier will still be able to have as long of a fulfilling life as possible and to be able to spend it with his family and those he cares about most. But like he said in his annual letter, his primary focus is now his health, not on investing for his investors like he used to with the Aquamarine Fund. So people's priorities shift. And that actually plays into some of the key points he's also made about lessons he's learned in his letter, that it's recommended that people read that so we can glean some of his wisdom.
Yeah, absolutely. And that letter is full of very philosophical information. I mean, do yourself the favor of just reading that letter because he's really reflecting back on his life and, with Aquamarine. So there's so many things in that letter. And my thoughts go to he's still here. And like you say, let's hope he's got many years. He's got the most wonderful, beautiful family. He's got an amazing team at Aquamarine. So let's hope everybody gets to enjoy him for a very long time. And I also know he's going to do Value X at Berkshire this year and also did Value X at Clusters this year. So he's still going strong, but yeah, is focusing on his health. So what has happened is that he sold the stocks owned by Aquamarine Fund. And out there in internet land, when he started doing that, the news still hadn't kind of gotten to the general public. So there was a lot of speculation to begin with. There were some people that said, oh, he's only focusing on Europe and Asia right now. He sold all his American stocks. It's a big political thing that is going on and a trend that's going on in Europe right now because of the current world situation. So there was a lot of people that was kind of spamming with that type of information and making people really like, oh, since Guy Spier is investing in Asia and Europe, then maybe that's also where we should look, spreading misinformation and so many rumors out there. But now the letter is out and everybody knows why he's selling his stocks. And I also called in a meeting with all my previous clients and mentees to tell them, don't just sell the stocks because Aquamarine is selling stocks. There is a reason why they're selling, and this is the reason. To begin with, I couldn't say, but then when the letter came, I could say, but it's just the reason is because one of the things that I look into myself and that I tell also my clients and my mentees is that look into what the gurus are doing. Don't just blindly do whatever they're doing. But I do that and I've shared that. And that's why it's so important for me also today to say to some of the people out there, just in case we mentioned it in the past, don't just blindly follow and copy trade or sell whatever they're selling. There could be an underlying reason that we don't know about.
Yeah, exactly. And now we know Guy Spier is winding down his fund and he has to focus on his health. So it's not because he has some sort of agenda against American companies and is only favoring international stocks. So that is good to know that that's why they want to end on a high note. Like instead of Guy Spier giving back money to his investors or giving them the chance to stay invested, after he consulted with several other people, he decided it's better to end at a good place in the career of the fund that he ran for 28 years and just give everybody's money back, and they can decide who do they want to invest with next. Or maybe they want to invest on their own. Maybe they learned a lot and they feel confident like that they can be good enough investors and they don't need to seek a fund manager to invest for them. Who knows? But that is something that he reflected on in the letter about he wouldn't want to have a situation where people remained invested in his fund and then he's not sure how his future health situation would be like. So he didn't want to maybe get blamed if things didn't go so well or the fund was not generating enough returns anymore for some investors. Then they could try to blame him and say that he is doing a bad job. But now that he's been transparent with everybody, he's giving everybody the same treatment, which I think is the right thing to do. I think instead of leaving it to chance and not knowing what the future will be like for the investors in his fund.
It speaks volumes to his character, in my opinion, because some money managers out there might have just continued and maybe let some junior portfolio managers overtake the fund. And of course, that could have gone well too, but it just speaks volumes that his character is taking care of his investors and making sure that they are moving on in a good way. I'm sure that he's been given some names also to some people that he would refer to manage their money if that's what they wanted to do. But I just think that's saying, okay, it's time now while I'm still in good health, respectively, to actually start to wind down the fund. And I also think I read something about he was, like last year, I read something about he was one of the best performing fund managers of last year. It's probably been super amazing having had him as a fund manager. So, but I also know, Michelle, when you were reading the letter, you actually came across some good advice that we should also pay forward to the listeners here from the letter and what to look for in an investment manager.
Yeah. And actually, before we get into that, maybe we should end this episode here.
On that cliffhanger, you guys come back. Maybe, you're also welcome to read the letter. Find Guy Spier's letter. Maybe he shared it on LinkedIn. I've seen it posted multiple times on LinkedIn. I got it through his newsletter, but it's probably not going to come if you sign up for the newsletter now. So maybe you can find it somewhere out there and you could read it. And then you, after, come back to the podcast and listen to what we have to say about it. So we will end the show on that high point, and we'll be back on Tuesday in 2 weeks.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.